5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. More pressure. Treasury Secretary Scott Bessent calls for an exhaustive review of the Fed's building renovations. That as Chair Powell is set to speak at a banking conference later this morning. And the S&P 500 notches another record ahead of a busy day and busy week of earnings. It is 20% of the market cap of the S&P 500 that will be reporting. And into that, we've just had this slow summer melt up. It's been pretty poor breath. I think something like only 8% of the S&P 500 has reached a one-year high alongside this index. We're a little bit weaker this morning. Emphasis on a little bit. S&P futures down 0.1%. NASDAQ 100 futures down 0.2%. We're going to catch up with Valerie Teitel with her movers in just a moment. But she pointed out this is a market that hasn't moved more than 1% in either direction over the past month. Now, for this Treasury market, it was a rally yesterday. Again, there's pressure from Scott Bessent, who said that there needs to be an exhaustive review of the Fed. He puts out later on X, he was talking about non-monetary policy review, not monetary policy. Even so, we are weaker this morning by only 1 basis point for your 10-year yield. 4.38% is where we stand. Let's get some of the stocks moving in the pre-market. As promised, with that is Valerie Teitel. Hey, Val.
Good morning, Danny. With that dampened volatility, we have a return of meme stock mania. Open Door Technologies. This stock is up 312% in the last 6 sessions. It's up again in the pre-market. It jumped 120% intraday, Danny. This is a stock that it's a website actually that buys and sells real estate, but that's not important. What is important is that someone tweeted about it a few days ago, and it's gone viral in the retail space. So keep an eye on Open Door Technologies. The return of meme stock maybe goes out to the broader market. But let's move on to names reporting before the bell today, because there are a lot. One of them is General Motors. This is going to be an interesting one, Danny. They are most exposed to tariffs when it comes to the giants around the auto sector. They report before the bell. We also have Coca-Cola. This is good, guys, for how the consumer is doing as well. Aside from these, we do have a few defense names reporting this morning, one of them being RTX. We also hear from Lockheed Martin and from Northrop Grumman. So keep an eye on this defense trade. We know that European defense, at least, has had quite a year. These U.S. defense names are also rallying this year on the back of that. Danny.
Some stocks to watch out for. Valerie, thank you so much. We'll catch up with you later in the hour. Also this hour, in just moments, we'll speak with Lucy Baldwin of Citi, who joins us to discuss the U.S. exceptionalism she sees in equities. And later this hour, we'll look at the credit market with BlackRock's Amanda Lynam. But the focus on markets this morning, since sinking to lows in early April, the S&P 500 has rallied over 25%, closing in at another record high yesterday. Citi's Lucy Baldwin writes, quote, return of U.S. exceptionalism in equities, but not in FX. U.S. exceptionalism is back, with the AI trade making a comeback. Growing capital expenditures should be a tailwind for equities, and weak sentiment suggests that investors are still waiting for a pullback to add risk. I'm pleased to say that Lucy joins us now. She's Global Head of Research at Citi. Lucy, good morning to you. Thank you so much for joining. U.S. exceptionalism is back, but as you note, it's largely tied to an AI trade. Just how crucial is this earnings season with the big tech players starting to report tomorrow?
Good morning, Danny. Thanks for having me. And absolutely, we would take the view that the US exceptionalism thematic is back for the AI trade, and in particular, those big tech names. I think the bar is relatively low coming into this earnings season in terms of expectations. So I think that will be a positive for sure. And as you noted, this AI trade we feel has got a significant amount of room to run. But how I would caveat this is that we are already at our 6,300 year-end S&P target now, and our mid-year target for next year is 6,500. So I think it is much more about selection under the hood than necessarily expecting a significant rally from here. I think the broader macro backdrop is clearly still pretty supportive, but the impact from tariffs, Danny, is really still yet to bite. We're starting to see in some of the inflation data, such as the June CPI data, some of those price pressures from tariffs starting to creep in. We're starting to see higher prices being passed on to the consumer. In some places, people are going to be watching and seeing whether corporate margins are starting to come under pressure as we go through this earnings season. And all of those sorts of things are obviously going to impact consumer spending going forward and, crucially, the labour market. So we're really very focused on how that labour market softness might evolve from here. And, of course, we'd just highlight things like some of the private sector hiring data has definitely softened. So our sort of economic view for the back end of this year is that softer growth thematic, is a bit more inflation. And of course, all of that does make things complicated for the Fed. We're expecting to see 3 cuts this year, but there is a risk that maybe they can't quite do 3 and it ends up being 2. And then we've got a little bit more cutting, another 2 cuts in the early part of next year.
Lucy, in terms of things starting to show up with inflation, we saw in the latest CPI report, it was things like furniture, electronics, appliances, and those categories also declined when it came to retail spending. Is this a consumer that is finally more sensitive to price increases, whereas it had been very resilient, consumer spending, throughout the past few years?
Well, we all know not to bet against the US consumer, but it would be fair to say that we're expecting to see more softness there. So when we think about things from an equity strategy perspective in the US, we would be more underweight the consumer, we'd be more overweight tech, we'd be more overweight financials. So we're definitely very focused on how that can evolve. I think it's fair to say that for now, the resilience has absolutely been there in the economy. But what we continue to suggest to people is that broad diversification theme. Because, as you noted earlier, it's not just going to be about exceptionalism with the big tech names in the US, but it's going to be about this sort of unexceptionalism in FX markets. And so you've got to think really carefully when you're thinking about your global equity exposure as to where you would want to have those positions, because of some of the dynamics that we think will continue to unfold in FX markets. And as you say, dollar weakness, although it's a very consensus trade, is one of those themes that we would expect to continue to play out. And that's really important as we think about earnings. But from a consumer perspective, yes, I think the consumer has held up very well, but we would expect to see that weakness starting to materialise as we go through into the second half and as that labour market weakness starts to unfold.
Well, through June, the dollar has fallen for 6 consecutive months, at least judging by the Bloomberg Dollar Spot. That's something it hasn't done since August of 2017. Lucy, you're expecting that weakness. Is there anything that could break the trend realistically?
Well, I think whenever you've got a very consensus view on something, there's always a lot of risk to that, undoubtedly. And I think, part of where we've been thinking about this theme of the dollar weakness has been linked to, if you like, this sort of the fiscal dominance thematic, the risk that a country's fiscal position and the high levels of debt and government spending are going to really risk constraining your monetary policy. We've just seen it kind of play out in Japan in the elections. Obviously, that's a country with incredibly high inflation relative to the G10, running at about 5%. You've had a lot of yen weakness. It's very complicated for the Bank of Japan there. And, that thematic where you're starting to see, obviously, the back end of the yield curve cause some problems and cause some concerns is a thematic that's playing out in a number of big markets, whether that's here in the UK or, of course, for the Fed in the US. And I think as we think about that is quite an important theme to understand as we try and forecast the dollar into next year, because, of course, things like Fed independence that have been a topic recently, all of that have risk in terms of making the back end of that yield curve less stable and more volatile, and continuing to see that steepening. I think what we would say is that we actually forecast into next year a little bit more dollar strength. So we actually do see some upside risks. So, for example, obviously we've had the big beautiful bill passed in the US. That is going to be stimulative. Now, I think our core view is broadly the negative effect of tariffs are going to be offsetting the positive stimulative effects of that bill. But there are scenarios under which you could expect to see some of that stimulus coming through from the bill, really providing that tailwind to earnings and better than expected growth. And maybe that means that the dollar actually can have a little bit of a rebound into next year, rather than the view that you actually see it just continuing to come under pressure because you start to see the Fed cutting this year and into next year.
I was going to say, can we just throw one more variable into that, Lucy? What happens if we get a very, very dovish central bank chief at the Fed next year?
Yeah, and of course, that is a big debate, big discussion. We've seen, obviously, the two Kevins, Kevin Hassett, Kevin Walsh, two of the potential frontrunners for that Fed chair role next year when it changes in May, both talking about the need for cuts and the ability to cut from here. I think clearly Fed independence is really, really crucial. There's a lot of great research written about that. And so what I would say is there is obviously a risk if you had somebody that were in that seat that were perceived by markets as more likely to be less independent, then the risk is you get that steepening of the curve, right? And you get to see, the 30-year would almost certainly go back above your 5% levels again, and you'd start to see those concerns come back into the markets around who is going to buy all of this supply as more debt is issued. And then you'll get the debates around what levels of duration are really going to be most attractive. And I think it's that big thematic around the world is really critical as governments politically are under pressure to spend from a fiscal perspective in infrastructure and other things. Who is going to fund that from a debt perspective? And what returns are sufficient for the kinds of risk that you end up having to take in those scenarios where you've got levels of debt sustainability that are very questionable. Clearly the US, if you look at it now and you think about, most people have 6 or 7% deficits extending out over the next few years. And if you think about the interest cost, even with a 4% US 10-year, your interest costs from a total perspective start by the mid-2030s to become greater than what you're spending on your Medicare, your healthcare programs and your social security programs. So that's where investors get very concerned about that fiscal outlook.
Lucy, this has been a masterclass. Thank you so much for joining this morning. Hope to catch up with you again soon. Lucy Baldwin of Citi. Now let's get you some other top stories that are trending on the terminal this morning. And BlackRock has told its staff to use temporary loaner phones and not to bring company laptops when traveling to China for business. That's according to an internal memo seen by Bloomberg. Employees have also been notified that they would not have access to the firm's network during personal travel in the country. Shares of Lynam are seeing their steepest drop since early 2022 after the chocolate maker's earnings missed estimates. It also reported a weaker than expected volume growth, facing soaring cocoa prices. The team at Batter noting that Lynam's volume growth in the first half was lower than in either the financial crisis or the pandemic. And the Bank of England is said to be mulling whether to set aside its plans to create a digital pound for households. Bloomberg learned that the BOE has instead privately urged banks to come up with payment innovations that could result in similar benefits. Coming up, a renovation review. Treasury Secretary Scott Bessent calls for an inspection into the Fed's billion-dollar building upgrade. We'll discuss that coming up next. You're watching your Bloomberg Brief. This is Bloomberg Brief. I'm Danny Berger in New York. Treasury Secretary Scott Bessent has called for an analysis of the Federal Reserve. He posted on X, quote, the central bank should conduct an exhaustive internal review of its non-monetary policy operations. Significant mission creep and institutional growth have taken the Fed into areas that potentially jeopardize the independence of its core monetary policy mission. Chair Powell was also set to speak at 8:30 a.m. at a Fed banking conference. Just a reminder, it is a Fed blackout right now, so it won't be on monetary policy. Joining us for more is Bloomberg's Josh Galou. Josh, great to see you this morning. And originally, Bessent was talking earlier yesterday morning on American media, asking for an entire Federal Reserve institutional review. Is this post on X kind of walking that back if he says it's not about monetary policy, the review that he's calling for?
It does feel a little bit like a stalking horse here. The context of the comments, of course, are that Jerome Powell's been under fire. Scott Bessent was even at one point considered to be a potential replacement for him. And the third element is, of course, Republicans' fixation on the budget and spending. So at the Fed, you have this renovation that's been going on for quite some time. It was originally meant to cost $1.9 billion. That that has expanded to $2.5 billion. The Fed's explanation is, of course, the building is nearly 100 years old. It's built down by the tidal basin near the Potomac in Washington, and they've run into some problems with the foundation and that it's built on a former swamp. So the costs have blown up. But the administration's focus here is more, or at least Bessent, his focus is more on some of the Republican talking points, right? Saying like, well, we don't want to be building lavish, spending on lavish offices at the Fed. We're trying to save money, and calling it mission creep, and undercut at Jerome Powell, of course. So we'll have to see where this goes and whether there's much to it. Congress is probably not going to balk at the opportunity to investigate the Fed, though. That's something that they would probably jump on.
Well, Congress wants to get a lot of stuff done before the summer recess, Josh. And I wonder how much this blow up over Epstein, that's become bipartisan with both Democrats and some Republicans pushing for more investigations, how much that's affecting what can get done in Washington, D.C. right now.
Right now, it's having a pretty significant impact. So this is the second week, really, that Democrats have been able to use that issue to sort of derail some of the legislation that Republicans want to get passed on a fast-track basis. The way they're doing it is essentially by trying to get Republicans to hold a vote on the release of Epstein files in the Rules Committee. The Rules Committee is really important here because it's going to decide whether some of this Republican legislation can go through with a simple majority vote, or if it needs the usual two-thirds vote. If it needs the two-thirds vote, obviously Democrats then are able to vote against and stop legislation. But with the simple majority, they can't, as we saw with the one big beautiful bill that got through on a simple majority. So what they're putting Republicans in a difficult position because they're forcing them to vote either on releasing the files entirely, or as President Trump wants, to release the indictment files. So this is putting them in a tough position. It's been building for a couple of weeks, and right now it looks like the Democrats are having a lot of success in delaying Mike Johnson's agenda.
Josh, thank you so much for that update. That is Bloomberg's Josh Galou. Now, keeping things in Washington busy as well as a looming trade deadline, Press Secretary Caroline Leavitt has reiterated that there will be no postponing.
The August 1st deadline is just really the start date for when the United States of America will begin collecting this revenue from all of the countries around the world who the president has sent these letters to. You could see some more letters before August 1st, John. You could have some more trade announcements as well.
The chief trade negotiator of Japan and Commerce Secretary Howard Lutnick met last night, as the two nations try to reach a deal before President Trump's deadline next week. Let's bring in Bloomberg's Brendan Murray for more. So, Brendan, it is a week and a half away. It is a market that is largely now ignoring any of the most recent developments. How should we judge the type of deals and whether deals are getting done as we approach August 1st?
Well, this particular negotiation that's going on between the U.S. and Japan has been pretty much stuck at nowhere, going nowhere for the past couple weeks because Japan was facing its upper house elections. With that in the rearview mirror now, there's some hope that they could kind of reach some sort of framework arrangement, that Japan would give a little bit on agriculture and the Trump administration would give a little, would ease back on the auto tariffs. But it really boils down to Japan cannot face these 25% tariffs on their auto exports to the U.S. That will just crush their the heart of their manufacturing base. And so it's issues like this that are bogging down other talks, like the U.S. talks with the European Union, with Korea. India is also talks in talks that we understand have been close for weeks, but they still can't get the deal over the goal line. They still have a week and a half left, but it looks like that August 1 deadline may have some flexibility to it. Treasury Secretary Bessent has said it's not. We don't need quick deals. We need good deals. So he's kind of indicated that there might be some delays built into that, or at least some temporary deals announced with more talks to continue in the future.
Brendan, you've also been doing extensive work following the flow of goods amid all these tariff tensions. And we saw in the beginning of the year a significant amount of front running. What do the ports look like now? What do shipments look like? Have they dropped off significantly?
Well, the view from the ports over the past couple of months has been there was a big drop-off in April, a big build-up in April, and then a drop-off in May and June. And now all of that front-loading, it makes the second half of the year look pretty bleak when it comes to import volumes through the biggest U.S. ports. There is some speculation that it could be one of the biggest reversals after an almost 15% increase in volumes last year, year over year, to a decline this year, and that would be something that's been pretty much unprecedented in the past 6 decades.
Brendan, thank you so much. Bloomberg's Brendan Murray there, and you are watching Bloomberg Brief. Let's take a look at the front pages this morning. Leading on the FT, they're reporting that Morgan Stanley is exploring lending against its clients' crypto holdings. It's the latest move and a sign that U.S. banks are endorsing the move of digital assets into the mainstream. Just 8 years ago, recall, JP Morgan CEO Jamie Dimon had called Bitcoin a fraud. And on the Washington Post, MAGA focuses on Jeffrey Epstein. Trump looks to focus on anything else. The president has posted in recent days about an Obama-led conspiracy and the sports teams reverting to old names, while his once loyal supporters continue to ask about a potential cover-up surrounding Epstein. And our reporting suggests that it really has derailed the House agenda, meaning they might move into an early summer recess. Meanwhile, let me give you a look at the dollar over the past 2 days, because it started to unwind some of the gains that it's seen this month. The dollar seeing its biggest daily decline since mid-June yesterday. Some of that led by a strengthening in the yen. Coming up, we speak with Amanda Lynam. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. More pressure. Treasury Secretary Scott Bessent calls for an exhaustive review of the Fed's building renovations. That as Chair Powell is set to speak at a banking regulation conference later this morning. And the S&P 500 notches another record high ahead of a busy day and a busy week of earnings. It is a record high, but it is a melt up into that record high. We've seen very thin advances, and this morning that turns into a decline, down 0.1% for the S&P, down 0.3, just thereabouts for the NASDAQ 100. It has been an advance led by the Mag 7, led by AI. We're going to get Alphabet and Tesla reporting tomorrow. Yesterday was a big global rally for the bond market. Again, that eases somewhat this morning, just barely higher by about a basis point for the 10-year yield. Bessent talking about the need to examine the entire Federal Reserve institution. But on X, he goes on to clarify yesterday he was talking not about monetary policy. That helped to bring yields down throughout the day. Let's look at some individual stocks on the move. With that is Valerie Teitel. Good morning, Val.
Good morning, Danny. We have a return of some meme stock mania. Open Door Technologies rising again in the pre-market, up over 12%. This stock intraday yesterday jumped 120%. It's a website platform for buying and selling real estate. Someone tweeted about a few days ago. It's had a massive six-day winning streak and has attracted a ton of retail volumes. Let's see if this kind of frothy activity does expand into wider markets. But let's move over to Switzerland. There was a key earnings release from Lindt, which I think is quite telling of the macro environment. The stock is down nearly 7%. Its worst slide in about 3 years. In this earnings release, it is going through how it's battling the rise of cocoa prices, maybe bringing front and center that's not just about tariffs. There is some lingering goods inflation that these companies are dealing with. But Lindt Chocolate, the volumes for the first half, Danny, were even lower than they were during the pandemic, even lower than they were during the financial crisis. So that stock is not having a good day in Switzerland. Headed into the opening trade so far this morning, though, we do have a few stocks to keep an eye on that are reporting before the bell. General Motors is going to be reporting in about an hour. That one's going to be interesting on how the auto sector is dealing with these tariffs that are in place. And then Coca-Cola comes around 30 minutes later for maybe a good guide on how the consumer habits, how those consumer spending habits are handing up. Danny.
Will be some really interesting earnings to look at. Valerie, thank you so much. Now, meanwhile, BlackRock's Amanda Lynam is anticipating a more challenging growth and inflation mix in the U.S. for the third quarter. She writes, quote, near-term preemptive rate cuts from the Federal Reserve are unlikely. Against such a backdrop, many market participants are focused on how corporate borrowers have been navigating this environment and whether new signs of stress in credit fundamentals are emerging. She is head of macro credit research, and Amanda joins us now. Amanda, it's not just market participants. I know this is stuff you've been digging through as well. Have you started to see any signs of stress in the credit market?
Good morning, Danny. Thank you for having me. I would say the credit market is showing signs of a general resilience, with the exception of some left tail pockets of stress that were generally in place even before we started to see concerns around the potential growth slowdown. I would say, to be clear, our expectation is for slowing growth from an above trend pace, which actually is a backdrop that the credit market can likely easily digest. We were never really expecting a recession, even at the height of the uncertainty on the policy front. And that solid corporate fundamental backdrop has also been coupled with a good enough macro and really supportive technicals. So there's a bit of a confluence that's allowing the credit market to continue to climb this wall of worry. And actually, credit spreads have retraced and are sitting at the tight end of the post-financial crisis range, which is really extraordinary given all of the volatility that we had in the second quarter, at least at the beginning. I would say, as for the left tail pockets of the market, you are seeing signs of distress in certain kind of themes. So we're seeing a bit of repeat defaulters. We're seeing smaller companies default at a higher rate. We're seeing loans outpace high yield bonds in terms of defaults. So there are some pockets of stress. It reinforces the case for being very granular and also the case for dispersion. But in general, I would characterize the credit backdrop as one of a pretty healthy resilience so far, at least.
Does that mean when you look at, for example, Moody's had this report out last week saying that the amount of defaults or likely defaults is at an 11-month high? Amanda, that is really just confined to the pockets you're talking about, that we shouldn't look at those statistics and be worried about the overall corporate credit environment?
It's a great point. It begs the question, when defaults are elevated like they are, at least in the loan universe, as I mentioned, why isn't it derailing performance? I would cite two things. One, it's the smaller capital structures that are defaulting. So in terms of, in general, so in terms of the ability to impact overall index level performance, the bar is a little bit high. And again, those repeat defaulters, currently, then this is using data from JP Morgan, 30% of the defaults so far this year have been repeat defaulters. So companies that defaulted a year ago, they completed a distressed exchange, they're defaulting again. This is the third consecutive year where that number is above 30%, which is quite elevated. So by definition, that stress should be incorporated into market valuations. Oftentimes you see this, that the market gets ahead of these actions, whether it's a default or a downgrade or even a ratings upgrade. The market participants are doing the work. They're listening to the management teams. They incorporate this into valuations. So oftentimes by the time the event, a default, a downgrade, an upgrade happens, it's oftentimes already incorporated in the valuation. So it makes sense to me that it's not enough to derail the performance of the lowest quality pockets of the market. And in fact, we're still comfortable with our view to selectively move down in credit quality. Again, not chasing all the way down into the lowest rungs, but selectively moving down in credit quality. We're still comfortable, and high yield and leverage loans have outperformed investment grade year to date on a total return basis.
Well, Amanda, you just mentioned earlier that it's been spreads that have been grinding tighter. And one of the outputs of that is you have something like Microsoft that is now more highly rated than U.S. government debt and has really robust cash flows. If you're looking at a lot of IG corporate bonds, be less volatile and have higher total returns than the Treasury index, does that change investor perception about what is a safe asset, about what is a haven right now?
Sure. This question does come up from time to time. I would say it's important to keep in mind that in the corporate credit market, there just aren't a lot of AAA rated companies left, very different from the pre-financial crisis period. So when you think about market segmentation, oftentimes technicals dominate in those structures because there's just not a lot to go around. There's just about 90 billion of AAA rated corporate debt, which is pretty small in the context of the overall US IG market. More broadly, I think there is a view that actually even moving down in corporate credit quality within the investment grade sphere is a pretty attractive view from our side, from a relative value perspective. Even, for example, for an investor that's confined to the investment grade universe, if they're dropping down into the triple B pocket of the corporate credit market, generally those companies are committed to investment grade. They still really have healthy fundamentals. And really, they're navigating this backdrop of policy uncertainty with a fair degree of resilience. So even moving down in quality within investment grade is something that we like. And I think that speaks to the overall positioning of the corporate landscape in this environment.
Well, it's been an extreme lack of volatility. You can see it in credit, you can see in equities, where the S&P hasn't swung more than 1% in either direction for over a month. Amanda, it's another earnings season where we're likely to get a lot of companies giving the, I don't know what it's going to look like, maybe scenario analysis, maybe not issuing guidance. Is there any reason to suggest that this earnings season might be the thing that breaks some of the market calm?
I actually think the bar for this earnings season is pretty low. And our expectation is that corporates will compare favorably to what are fairly low expectations. The one thing, Danny, that I found notable is that companies over the past month and a half have been a bit more forthcoming about the operational levers at their disposal to navigate this backdrop. I think that's different from what we heard during the first quarter earnings season, where there was still a lot of ambiguity. I think that's part of the reason why risk assets have been relatively resilient, is that corporates are showing the different operational levers that they have. Some of those could include cost-cutting plans that were supposed to happen over the next few years. It could be negotiations with vendors, using more automation. Really, the list goes on. There are about 10 things that we hear consistently that corporates are citing. I think if I had to pick one signpost to watch for the second quarter earnings season, it's this feedback loop between corporate margins, the layoff rate, which is still low, consumer spending, and overall economic activity. We're in a low hiring, low firing environment right now. So if corporate margins are pressured, the risk is that those firms flex that layoff tool more aggressively. That feeds through to consumer confidence. And then, of course, consumer spending is 2/3 of overall economic activity in the U.S. So that's where we should be watching. Just like during the pandemic, that high frequency company level commentary will be really important. But again, right now, what we're hearing from corporates is a bit more forthcoming about the operational levers at their disposal. So our bias is to be, I would say, somewhat cautiously optimistic about corporates' ability to surpass what is a pretty low bar for second quarter earnings.
Yeah, fair enough. And we'll get about 20% of the S&P market cap reporting this week. Amanda, thank you for helping us set up for it. Amanda Lynam, always a pleasure to have you on, of BlackRock. Let's get you now some other top stories that are trending on the terminal this morning. And the White House says it would remove the Wall Street Journal from the group of reporters traveling with President Trump on his upcoming trip to Scotland later this week. That's after the newspaper published a story alleging that the president once sent a suggestive birthday letter to late financier and sex offender Jeffrey Epstein. LA Times owner Patrick Soon-Shiong plans to take the newspaper public over the next year, he told Jon Stewart on Monday night. If an IPO goes ahead, the LA Times would join the New York Times and News Corp among the largest publicly traded news organizations. The billionaire has owned the publication since 2018. And BlackRock has told its staff to use temporary loaner phones and not to bring company laptops when traveling to China for business. That's according to an internal memo seen by Bloomberg. Employees have also been notified that they would not have access to the firm's network during personal travel in the country. Coming up, more pressure on the Fed. Treasury Secretary Scott Bessent calls for an inspection into the Fed's billion-dollar upgrade for their building. We'll discuss that next. This is Bloomberg. You're watching Bloomberg Brief, and I'm Danny Berger in New York City. Treasury Secretary Scott Bessent has called for an analysis of the decision to upgrade parts of the Federal Reserve headquarters. He posted on X, quote, "While I have no knowledge or opinion on the legal basis of the massive building renovations being undertaken on Constitution Avenue, a review of the decision to undertake such a project by an institution reporting operating losses of more than $100 billion per year should be conducted." Joining us is Bloomberg's Josh Gallu. Josh, this isn't the first time we've heard this criticism of the Fed's Eccles building. It's something that Trump has talked about. Other members of the Republican House and Senate have talked about. Is it different, though, if we have Scott Bessent also making this call?
I think it is. Of course, Bessent's been on the short list as a replacement for Jerome Powell as head of the Fed. So, you have to take that into account when you read that. And then, his comments clearly serve a couple of different Republican talking points that people on the Hill want to hear. One is about spending. So this project began as about a $1.9 billion renovation and construction, and now it's up to about $2.5 billion. The Fed, of course, says when you're dealing with a building that's 100 years old, there are things like asbestos, and it's built on a former swamp that's added to the cost. But they're pointing to sort of a rooftop garden and lavish facilities, which the Fed has sort of said that it's not quite as lavish as you're making it out to be. You have that on one side, right? It's really speaking to the Republican talking points that we've heard all along about budget cutting and cost consciousness. And then on the other hand, of course, any opening for the administration to go after Powell is being seized. So here, they're obviously not going after monetary policy and interest rates, but it's another opportunity to take a dig at Jerome Powell and potentially undermine his credibility as head of the Fed when they really want to make a change there.
Hey, Josh, just quickly, as Congress deals with the last push until the summer recess, you've seen really the Democrats push for more investigation into Epstein and some Republicans following suit as well. How much is that derailing their schedule at this moment?
Right now, it's really having a major effect. So it's all happening in the Rules Committee, where Democrats have put forth this idea. They want Republicans to have to vote on whether to release the Epstein files. And, that's forcing the Republicans to either ally themselves with their base, which is rather in favor of doing this, and President Trump, who is trying to limit the release to the grand jury testimony that was used in the prosecution of Epstein. It puts those lawmakers in a very difficult position, and by doing so, the Democrats are actually keeping the Republicans from moving forward with any kind of legislation that is in any way controversial, because it keeps them from pursuing a process where they can pass things with a simple majority rather than 2/3. That means with the recess coming up at the end of this week, it's very unlikely that they can get anything done other than very non-controversial and routine motions that aren't going to cause any kind of uproar.
Josh, thank you for that update. That is Bloomberg's Josh Galud. Let's turn to tech now. And Microsoft shares are slightly lower in the pre-market, down less than 0.2, but the tech giant has been rushing to stop hackers who exploited a security flaw in their software to try and breach businesses and governments across the globe. Let's get an update from Bloomberg Tech Europe host Tom McKenzie. Tom, we knew that this breach had happened yesterday, but we're learning more about the details. Just how extensive was this hack?
Very extensive, Danny. And as you say, look, there was a weekend patch by Microsoft, but this hack continues. We know that those malign actors, according to cybersecurity teams monitoring this, are still in many of these systems. You could be talking about 10,000 businesses and organizations globally, by the way. This spans everyone from the US to the UK, Canada, Brazil, and beyond. And in terms of organizations that have been hit, we know the Department of Education is among them, university in Southeast Asia, potentially 10,000 businesses and organizations that use the on-premise servers around SharePoint. And by the way, SharePoint, the hack has been focused on that particular piece of software. That opens up potentially the hackers to a whole ream of different products and services from Microsoft, including Microsoft Outlook and, of course, other parts of the ecosystem, Teams and Microsoft Office as well. So this is extensive, very damaging, of course. Microsoft has been under scrutiny already for some of its mishaps and oversights in terms of cybersecurity, not just from some of its clients, but the US government as well. So they continue to work on this. The one silver lining is that it is focused on those on-premise servers. So if you as an organization or a business have SharePoint that is hosted out of Microsoft's own servers, then you are unlikely to be affected by this. But they've taken, by all accounts, usernames, passwords, and tokens. Again, this is a global hack.
Tom, thank you very much for that. That is Bloomberg's Tom McKenzie. Now, elsewhere in corporate news, it is a busy day of earnings. We have autos, consumer companies, and defense. Among them is Coca-Cola, which is set to report before the bell. Bloomberg's Sabah Meddings joins us now for more. Sabah, we have seen some analysts be pretty optimistic about Coke's quarter. Why?
We are expecting a solid quarter, like you said, and that is despite what is a kind of jittery consumer environment in the US, various down trading, things like that. And Coke does have a really strong comparison from last year, so it is going to be a little bit tricky for them. But we are expecting adjusted organic revenue up 4.55%. I think what perhaps is more interesting for Coke this week is how it responds to Donald Trump's missives about high fructose corn syrup. The company did say last week, after the president said he wanted to have cane sugar in Coke, that it would provide an update today. So analysts are really looking out for what are they going to do? Are they going to launch a new product? Are they going to reformulate existing products? Probably more likely that we'll have a kind of a Mexican Coke style product using cane sugar launched across the US. Shares did rise last week when they said that there would be an update today. So yeah, all eyes on that and how that would affect the business. It could actually be a positive. It would be a slightly more premium product. And if you look at the kind of price mix, it could be quite helpful. But yeah, we'll be looking out for that today.
Yeah, it will be really interesting to see what they say when they report. Sabah, thank you so much. Sabah Meddings there with an update on Coca-Cola. Coming up, we're going to update you on what the rest of your day looks like. We'll have your trading diary for you next. This is Bloomberg.
What do you think your mark is going to be as the CEO?
The trend of private capital, as significant as we think it is, if we look back again to 2000 to today, it's early days for private capital. If you think about the big trends, demand for infrastructure, demand for energy, the demand for defense, and really what's happening geopolitically, the demand for private capital will only increase. I'm also generally an optimist. So I think industries will grow, investment will grow, and private capital will just grow to be a provider of capital.
As the Carlyle CEO, Harvey Schwartz, speaking with Bloomberg's Sonali Basak, and you can watch that full interview tonight on Bloomberg TV. It airs at 6 p.m. Eastern Time and streams on Bloomberg Originals at 8 p.m. Let's now get you set up for your trading day today because we have a flood of earnings. GM, Coca-Cola, Philip Morris, Lockheed Martin, among others, will be reporting. Meanwhile, Fed Chair Powell will be speaking at a banking regulation conference at 8:30 a.m. Eastern. Just a reminder, it is a Fed blackout period, so he won't be speaking on monetary policy. Same goes for Mickey Bowman. Fed Governor Michelle Bowman will also be having a fireside chat with OpenAI CEO Sam Altman, That's at the same event at 1 p.m. Let's look at some of the stocks on the move. Open Door. It is the new meme stock in town. Shares jumped 121% yesterday. It goes higher today, up nearly 15%, making up 10% of all stock market activity on Monday, just because someone tweeted about it. NXP, those shares are down 6%. It posted a second quarter sales decline. It was hurt by a sluggish automotive market. Meanwhile, CSX, those shares are up 4.5%. It's rising on a semaphore report that Berkshire's BNSF is exploring a takeover of either Norfolk Southern or CSX. Now, it is a record high that we saw in equities yesterday. That melt up takes a breather this morning. It's red across the board. We also saw the worst day for the dollar since June. A tough going there after it made up some of its gains this month. Meanwhile, your 10-year yield is little move this morning. But again, it starts out a busy week of earnings, really kicking off in earnest today and tomorrow when we will get Alphabet and Tesla. So you're looking at an S&P future session that is down 0.1%. All right, that is it for your Bloomberg Brief. Surveillance takes things from here. This is Bloomberg.